All right, good morning, everybody. The focus this morning is the job numbers. It's going to be the number one thing we're going to keep track of. So it looks like crude is going to make another attempt across these highs. In WTI, that would be 82 half. And on Brent crude, 88 to 88 half. There's a sloping trend line of resistance, a descending trend line that it's got to get through first. So we need to be watching this for a rejection. Some of the moves that happened yesterday started at 10:30 when the petroleum report came out. It's something to think about. All right, so we got additional auctions today at 11, 11:30, and 1 o'clock. Kind of interferes with the 0 days in through the morning session, but there was already a lot of other econ to worry about. You can see nearly every hour on the hour, there's something to deal with through the morning session. So if you're going to attempt to do anything through the morning, just be very cautious. It's more than likely that whatever news we get at 8:30 will carry us through the morning session, through the gas report anyways. So I don't see that new home sales would change the path of whatever gets set at 8:30. So if it's, if the market buoys at 8:30 and begins moving up and new home sales turns it the other direction, I don't think it's strong enough to drop it back down again. It can add to the fire. I guess we could say it that way, right? But if it's counter to the rest of the news, I don't think it'd be enough. I've been reviewing what the market does before FOMC. We talk about how the market is volatility suppressor. It's a volatility suppressor. But that's not always true. And sometimes we get these wild runs into the FOMC. It's like they sell the rumor of the FOMC doing something and then, buy the results, or they buy the rumor and then sell the results. And the reason I bring it up is we're kind of sitting in this odd situation here where we could be at 4,100 by FOMC, which would be kind of nice, right? To kind of retest this range that we've been in since December. So what we're going to be looking for today to see something like that in action is, first, we've got to get above January 23's high. So that's going to be the breakout location. If we break out of 40.39, then we're going to challenge 4,100, could overshoot it. Maybe if we overshoot, there is a gap over here that needs closed at 41.11. Yeah, close enough. A cog line. Of course it is. Now, it is possible that we make it to 42, but that would require more econ, more news, more something. And I don't think we have that, right? So I think that's a bit of a stretch, but 4,100, 41.11. Yeah. So keep your eye on January 26th high of day, breakout above that level, and it's a go. Now it doesn't have to do anything. Notice for the ES that the January 23rd level is very close by. We were looking at the SPX, now we're looking at the ES. 40.56.75. Just right around the block. One of the things that brings all of this to the front is Microsoft's recovery yesterday, which I mentioned in the pre-market in the morning briefing. Be careful. I've been short Microsoft for months, and my short just continues to disappoint me. Its recovery tied in with Tesla's good earnings, and Apple's still on deck. 4,100's in play. Looking at the volume this morning, you can see how we're kind of light. We're still below that weekly average, the red line here. We're opening lighter than we did yesterday, around 84, when yesterday was about 103. This is the IB, the initial balance. So you can see it was very narrow. We haven't really expanded much beyond that. But we do have a little bit of a setup, even with the job numbers. We've set a high. And what we have on deck right now is, unless the job numbers create one of those big expansion bars, something like what it looked like when we had CPI, right? Some big expansion bar, either direction. It didn't have to be up. Unless we get one of those, what we want to be watching for is a pre-market challenge back up into that level, and then a rejection, a fade back to the IB, and an explosion to the upside once the market opens. If we do get one of those big expansion bars, we're going to look for that big move to get reset first to close the gap. So if you're not familiar with the gap that I'm talking about, it's not really a gap, because it's a liquidity gap. So you still see candles. This is December 13. And we had an economic report in the pre-market. We had this very large expansion move here. It creates a liquidity vacuum. And what we find most of the time is, after a really big explosion like this, that it will come back down and reset. It'll come back where it came from before it does anything else. So with the job numbers this morning, if we do get a big move, we're going to look for that big move to be retraced. You know, it doesn't always retrace, right? It just retraces more often than not. And it doesn't have to be an upsize move. It could be a downside move as well. So if we don't get one of those big bars, we're going to look to retest against that white line that I've got there, about 40, 50. And then perhaps one more pullback. I think the market's going to try to avoid breaking out higher before the open. If it does break out higher before the open, even higher than, not even waiting on the job numbers, then, you know, fine, we just scratch that play and we move on. 40.56, this high from back here, that January 23, is still the one that you want to focus on. I continue to see questions about fair value. And it seems to me that whoever is putting that kind of material out really needs to do a better job of explaining what it is. I never use that phrase in here, probably because what I'm analyzing has nothing to do with fair value. Go back and reread the material on fair value. If the news is negative this morning, look for either a recovery like yesterday, or that we drop to those lows and still maintain the range, right? We're still going to be focused on the idea that as we come closer into FOMC, we're still going to maintain the range for the downside. So unless things get really, really nasty out there, we're not going below 3,800 before FOMC. It would take some very drastic news. Now, it's possible, right? And this is something I have to stress. When we were going over threats to the market right now, there still are a lot. Japan is changing leadership. What they have been doing with their monetary policy is about to change. And nobody quite knows what the new one's going to be. And we don't know how it's going to affect the market. But it's a really big deal. This last run here, where we had the October lows and we rallied back up and we had these really big expanding weeks, those were from Bank of Japan yield control intervention hand in hand with the Fed, right? They worked together and we had that save the market in that early October and then the rally back out. So Bank of Japan interference can cause some really crazy market moves. And that's on deck. And it's on deck for the next 3 months. It's a really big unknown because nobody has any idea what's going to happen. So that's one threat. Then the New Zealand Prime Minister, the new New Zealand Prime Minister, is signaling a policy overhaul. One phrase out of line, just one sentence where he chews on his own foot can dump this market. And that's what happened over in Europe when they were changing leadership. And then there's still the situation with the Russia-Ukraine war. And there's still a threat of one Asian country invading another Asian country. So those are all on the table right now. And Europe is still suffering from energy costs, really extreme energy costs. So there are some really big unknown threats with the Bank of Japan, and there's all the other potential maybes. So we got enough to worry about. But without some kind of a catalyst, I don't see anything that would get us below 3,800 before FOMC. And it would have to be some pretty negative news to even get us through this angled trend line. All right, there's the push. It didn't want to wait after all. So they're going to front run the job numbers and the 8:30 econ this morning. Trying to think back to a day where we had a pre-market like this, so we got something to compare with. But we haven't had one close enough for a while that I could zoom back to. Yeah, I'm just going to leave it with 4,100 is absolutely on the table. And there's really only two ways we're going to get there. It'll be one of those massive rip your face off rallies like we had from Friday to Monday afternoon, or it's going to be just an absolute mean grind where it's difficult to trade and it's choppy, but we keep closing at the end of the day higher than where we opened and we just grind our way up. It's going to be one of those two. If we rocket up there in a day and a half or 2 days, that will be the ceiling into FOMC. Wherever we top out in the push, that'll be it. It won't retest and then break out again before FOMC. So continue to focus on any news article out of the big major firms like Bloomberg, Wall Street Journal, even FX Street, anything on Bank of Japan and that entire situation over there. I have some dates saved that I could post in later on. Important dates for Bank of Japan interactions. We can do it this way. That way you guys can just take a screenshot. Now, I didn't put this together. You can see down at the bottom, I left the source on there because it's not mine. I didn't make it. But you can get it off of Reuters. So just take a screenshot. You should be good to go. Mark those dates down. All right, we're getting follow through with US dollar Japan, US dollar China, and the Dixie, the DXY. So this push, I don't think the only let's say it another way. I see this push is going to stay sustained unless the econ at 830 is bad. If it's wishy-washy, kind of, sort of okay, or if it's good, we're just going to continue to go. So it's going to have to be some pretty drastic numbers. Now, remember, in the current environment right now, when it comes to jobs, good job numbers is bad. So good news is bad for the market and bad news is good for the market. The Fed is trying to kill demand, trying to kill this runaway wage market, sticky inflation due to people jumping from one job to the next and pressing for higher wages. And so the numbers need to reflect that they are accomplishing their goals. Higher unemployment, which is bad, would be good for the market. It would give us that push to the upside. So bad news is good news, and good news is bad news. I believe the number that I heard was 260. And we're at like 205. So that median forecast That'd be a good ballpark number to focus on. Thinkorswim's having a rough time of it this morning. All right, so on that move yesterday, notice you had tech and finance working together, right? You get those two working in a team, and away we go. We had a really nice green line crossover to the upside, and then it led the way. It got tangled up a few times with that purple line, but it wasn't in the middle, right? And that's the main thing. So some really great signals on that reversal yesterday, and then confirmation of the reversal and participation for the run back through the other side. Very clean targets all the way back up from running back to the open and then getting to the Globex high and then getting to the high of the previous day, which we didn't quite get there, but yeah, it all lined up really well. All right, we're starting to get a little bit more of that classic P-shape profile where the top part has all of our volume. It's been a choppy mess in here for over a week. So, just the idea that we're getting even remotely close to a classic pattern again is kind of good to see. It's important to notice that we didn't make it back down to the bottom of the box. That got shut down in that reversal yesterday. So when we're at the low of the box, we expect to go to the high. When we're at the high, we expect to go to the low, and that got shut down. Now we're back up to the highs. If we get back down around that 40-11 cog line, that's where the point of control is at. It's the last structural level. Below that, 39.85 might give us like a first touch bounce, but it's not enough to hold the market up, right? That's not a support level like a handrail. You don't want to lean on that thing. Don't trust it. If we come into 39.85, we're very likely just going to get a light bounce and just drop right through it anyways. And if we go through that, it's shallow. There is nothing holding it back. We should move through it really quick like we did back here. Nothing slowed it down. It was just a straight run, and we moved through it back here. Nothing there, right? So the low of 39.60, I wouldn't even anticipate a first touch bounce there. There's just nothing there. And that's if we go in that direction at all, which, so far looking at things this morning, that's not on deck. The numbers are going to have to be like really good job numbers, which would show that the Fed is not accomplishing their goals, and that good news would be bad for the market. That's the only thing that would take us down at this point. Some really bad numbers. So the idea that we're in this double top pattern, or this there is a head and shoulders here. It's inverted, pointing to the upside. It's very ugly. You almost can't see it just because of how ugly it is. And the thing about a pattern, the uglier it is, the harder for everybody to see it, the less likely it is to play out. It's a little bit of that chicken and egg thing, right? Does a pattern play out because everybody saw it? Or did the pattern play out because the pattern is just a part of random walk market movement? My argument is, if most people didn't see it, it's probably not going to be traded. Add to the fact that an inverse head and shoulders is supposed to be at the bottom of the range, not at the top of the range. It's not a continuation pattern. It's a reversal pattern. So when you find one at the top, more often than not, you should just discount it or put it on like a secondary level of information. It's not your primary focus. There is a little bit of risk if you think about Investors Business Daily and their interpretation of double tops and double bottoms. Classic double bottom and double top should go farther than the previous pivot point. It's designed that way. So, it gets up in there, convinces everybody that we're really, really going to go long, sucks them all in, and then dumps it down on their head. They have to sell to close. It adds to the selling. Then we just get that runaway, big, massive sweeping move in the other direction. It would be the same thing, if we flip it all over and we were talking about moving to the downside. So this pattern here at the moment is actually threatening a downside movement. We now have a new VPOC. We got one yesterday. $39.88. And we're getting a lot closer to an old one at 40.76. So when we get up there today, anticipate a first touch pullback. If we get there today. Now, what I'm hoping we don't do is get the job numbers and see some violence and spike through that level in that violence, because there's a trade here. If we don't touch it until we get into regular trading hours and we work our way up to it nice and smooth. But if we spike up there in the pre-market with this jobs data, we wipe that liquidity out in a massive spike, well, that just sucks. Then we don't get the opportunity to play the VPOC line. So hopefully the numbers are just muddy enough that they have to call timeout, wait on the nerds to give them guidance, and we don't get some big explosive move at 8:30. I don't believe it, but we can dream. All right, normally when we're looking at this, we're looking to see which direction we're trending, right? The move past the 0 line, past the 10, and we climb up, and or we're climbing back down, right? We're headed back to the 10. So when we cross through and we cross over, which direction we're focused on has a lot to do with where I think we're going. We were headed back to the 10. We had started to roll over. And we had 2 days where we were working our way back down to the 10. And now we're pushing back the other direction. Now, this thing doesn't always go back to 0. There's times, like back here where we were trending back towards the 10, and then we turned and went back the other direction. So, we're not destined to go to 0. So this adds to my argument that 4,100 is absolutely on the table before February 1. And we're not overbought yet. So, as much as it seems like we've made some pretty expansive moves in the last 5 or 6 days, we're not very far above the 10-day moving average, 1.2%. And we wouldn't start to be overbought until we get near 3% past the 10-day moving average. So a long ways to go. We don't have to have any fear of we've moved too far and the market's due for a sell-off or anything like that. Same thing with the 10-week. This one, we're a little more outstretched. The reversal's still above 3. So as long as we're not more than 3% beyond the 10-week, then there's not a threat yet. But it's certainly something to keep your eye on. How far away from that 10-week we get is going to become more relevant when we get past 3. The weekly expected move is 40.84. 40.83. That was how far we were supposed to move within the week, right? That's a weekly expected move. So moving at least that much on the week is nothing, because that's what we were supposed to do starting the week. Well, overshooting beyond that by another 20 points and getting to 4,100, not a problem. All right, so it looks like they covered a lot of their shorts. They're just getting flat before the news. Kind of has me a little bit more on edge that the job numbers this morning could be a little more impactful than we think. And the thing is, there hasn't been a whole lot of chatter about the numbers. Like normally everybody gets all hyped up about it, but it's been kind of quiet. So whatever firm that was, they're out of their short. They bought, they covered to close. Now it's just waiting on the report. All right, so we have K-Web and emerging markets this morning, both up. We also have Bitcoin. And the thing about Bitcoin, one of the reasons that we keep track of it is all of those short names, high short float, short interest, heavily shorted names. When we came into January, a lot of those were getting cover, and we had these explosive 250, 300% moves. And it started out in that trash space, right? Penny stocks and cryptos and pot stocks, just these beat down, irrelevant trash names. But the flow eventually bled over into small caps, mid caps, large caps, and then we just had this swell since the first of the year. So we're continuing to watch that crypto space to see when that flow starts to dry up. It's just a representation of those penny stock trash names, just like the same thing with, K-Web and emerging markets. We're just using this to keep track of China, for an example, right? It's not necessarily like we want to trade the Bitcoin ETF or K-Web or emerging markets. We don't necessarily want to trade those. We're just using those for proxies and for like a gauge or a tool, an indicator. 23% of the S&P is up this morning, 0.5%. That is not overly bullish at all. That's barely bullish, which makes sense because if everybody's waiting on the sidelines for these job numbers to come out, they're not going to want to participate, right? They're not going to pile in and get heavy into these names. If you look at the market on close levels, they're really light. And they have been light, right, since the first of the week. So you see how they're kind of trending down, getting lighter. Yesterday at the close was 80 and 134, but the day before that, we were at 94 and 83. Neither one of them were above 100. It's just sitting right on the sidelines, right? Everybody's hanging out, waiting, not even really getting a capital rotation. They want the numbers. So it's not a surprise that we're not seeing a whole lot of follow through this morning. I'm sure that will change after 8:30. And for the NASDAQ, 36% of the NASDAQ is up this morning, at least 0.5%. And again, that's not very bullish yet, but it's about what we would expect waiting in front of some economic news. All right, some I've been watching is PDD. We're coming up into that $100 level again. When we got near it last time, twice, and we rejected both times. Really looking to see if we're going to get a new leg up in here. Now, it doesn't look like we're going to start that today, but it's certainly one worth keeping your eye on for a new opportunity. It's at 98 this morning. Third time's the charm, though. If we don't make it through there on this next test, I think we're going to challenge this green line, the 20-period moving average, and maybe retest that 50. There's a gap that needs closed on JD at 63.58. If we do get above that level, then the high of that January 23 candle is the one you want to focus on. Getting back to that level will be the money shot. Whether we wick through it or not, I don't see much expansion beyond it. Not today. Just getting there would be kind of the goal. All right, so with Tesla, it's already above all of this. It's sitting at 155, so it's up here. We're going to be looking for this to perform kind of like this, where it gapped up and then, or it gapped down and ran. In this situation, we gapped up. We're going to see if it's going to gap and drop or gap and run. If that thing doesn't begin to fall at the open, then it's a continuation buy. Now, normally we wouldn't want to do a continuation buy on a gap up like that, but we'll use Baidu here for an example, down here in the lower right. Maybe I should have used a better example. This one has a wick. You're not going to want to see any wick. So what you want to see is from where Tesla closed, and we're on Baidu here. From where it closed, we want to see it gap up, and then at the open with barely any wick to the downside, we want that thing to continue running to the upside. A lot of people are going to try to short it at the open just because of how far up it gapped. Those shorts are going to get squeezed and add to the buy. It could be an explosive expansion, even though it has already moved so far. That's part of the trick, right? And it'll just keep pushing and pushing as long as everybody keeps trying to short that thing, because those shorts will just keep getting squeezed and it'll just keep going. On the other hand, it doesn't have to do that at all. Just like with Microsoft yesterday, where it started out bad and rallied right back up out of it. This could start out good and dump right back out of it, right? So it doesn't have to continue. The line in the sand is going to be where we open, right? So wherever Tesla opens, mark that open. And if we continue to trade below it, then you're short on. And if we open and we don't retest it and just continue moving to the upside, well, there you go. It's an upside. NVIDIA has the same 3-bar chart setup as Tesla does. Closed at 193 and right now is sitting at 196. So a lot closer to that 200 level. 200 is not as psychological as a $100 level, but it is still a roundy. So anticipate a little bit of reaction at 200. Netflix is basically flat this morning, which should cause a little bit of a concern. With everything else doing really good, and Netflix being one of those names that has done good since the start of the year, it has no attention this morning. And we've got a nice setup here in Meta. So we want to focus on that big green candle. It's up in the pre-market about $1. It closed at 141.50. It's at 142.50 right now. So we want to see this thing do a breakout of this green bar and a nice expansion, 147, 149. BABA is barely up this morning, but it is up enough to have gotten outside of this box. So it's already outside of that. Not by much, though. All right, everybody, watch the clock this morning. Keep your eye on the prize. And really consider what a 6% move in the market would do to your portfolio. Because as we come into FOMC, when the announcement comes out, it could be a very explosive move. Now, it doesn't have to move 6%, right? It could do nothing and we could just stay ranged. So, you know, it doesn't promise us a big move, but that 6% move is easily attainable from, say, Wednesday FOMC into Friday of that week, up or down. And there's no telling which way it's going to go. So kind of look at what you're holding and ask yourself, what would it feel like if the market moves 6%? Because this is the time to deal with it before we get too close, right? And there's another FOMC in March. And then we've got, the whole Bank of Japan stuff really starting to coalesce in March too. So, there's a lot more threat in March than there is in February. Otherwise, play the range. Keep your eye on anything for Bank of Japan. And watch for Apple to lower guidance. This is a little trick that they've done before. They're not the only ones. Just, Apple's the one that's in focus. If they're going to struggle at earnings, they will lower the bar, right? They'll come out ahead of time. They'll do a pre-earnings announcement, and they'll say, we're not going to make that bar that we set. And then they lower the bar. Now, there are a couple arguments with that. If they didn't give us a bar on their last earnings, right? If you go back and listen, did they give forward guidance at their last earnings? If they didn't, then they don't have to lower the bar this time, right? Because they didn't set a bar. So you want to start there, check their last earnings, see if they provided forward guidance. And if they did, and they have not lowered it now, that's going to give you an idea of how their earnings is going to go. Because they will lower the bar and then step over it. Like, wow, look, we beat after we lowered it all the way to the floor. So one of the reasons that we might not have seen them announce a lower before this new earnings is because they didn't set one. You'd have to go back and check their last earnings to see. Gives you something to think about. I'll see you all tomorrow.